Well, ladies and gentlemen, boys and girls, it is, as always, a beautiful day to make some money. And this is how I always start looking for the next opportunity. Come here to Market Chameleon, where they have this table, this ranking by volatility. So the first thing I do is choose ETF, because ETFs in general they are safer than individual stocks. It would be really hard for an ETF, a big ETF, to disappear, to go to zero or something like that. So I always check the ETFs first, and I don't check any other boxes here. I just check ETF, and then I order them by current option volume because, of course, the most important thing is liquidity. After that, most important thing is the implied volatility. So I always check this column here, the position, which is more or less equivalent to the percentile. So I always keep an eye on IV rank and IV position because sometimes the IV rank is really elevated, but the position is not so high according to the history of that underlying. So you always have to check both of them. And as a general rule, IV rank over 30 and position over 30 as well, more or less, is a good start. So we have the usual suspects, the most liquid Spike, the Qs, Russell, and as you can see, even though the IV rank is kind of high, the position is low. So this is not really a good opportunity. But today, right here on the top of the list, we have GLD, gold shares, with elevated volatility in both criteria. So this is a good opportunity for us to try and make a trade. So even though the IV is low, I like to mess with gold trades because it's not super correlated to the market in general. And again, gold is not going to go to zero or anything. So if things go south, we can double down on our assumption that gold's not going to zero or to 1,000 quickly. So I think it's a good way to sell theta to make some money. So let's go to the option table, the option chain, and let's check as always if volatility is actually high, and it is. The IV rank's high, percentile is high, so yeah, we can trust the table. Sometimes it's different. Each side kind of measures different things. But since this is a liquid one, it's hard to have very different results from different sides. So we can go 39 days, which is the monthly expiration date, or we can go to the next one because it's such a liquid underlying that there's kind of a gap here between bid and ask, but it's still doable. But I prefer to go with the monthly because it's almost 40 days. It's all right. Now, if you check the chart, the price of gold, it's going up for a lot of days. It's been going up and up and up. Even though we don't use technical analysis, of course, but again, it's not likely that gold is going to have another run like that for the next 39 days. So I think selling a call or a call spread, credit spread, would be a nice idea. Since I already sold a call on gold, I'm going to check on the other side. That way, if the price continues to go up, I'm gonna have a winning trade on the put side, and if the price goes down, I'm gonna have a winning trade on the call side. So that's how I like to roll. I always like to win whatever happens. So not only is gold not exactly correlated to the S&P 500, I can also open trades on both sides of the price, so I win whatever happens, and then I can manage the other position, or I can close one position, and then if the price comes back, I can close the other one, and that's the way to always win in the markets. You don't need to close everything all at once. You don't need to bet on a direction. The important thing is to assess your risk, to trade on liquid assets. That way you can always win because the price always goes up, goes down, and whatever the price does, you lock profits in one side or the other. So here we can go, let's check delta here. Delta is already 26, so you could go a little lower and sell a naked put. Like if you go here, delta 18, delta 16, you could do this, or you can do what I did and try a spread. I think this one surprised me a little bit because I hate when they don't give me the delta. I don't know why they do that sometimes. But I think this is the one. It was delta, around delta 25 or something like that. And we can go with a $5 spread. Ooh, sorry. And we get almost 100, max loss 400. If we take the mid price, it will be 100 to 400, 1 to 4, which is, I think it's kind of a sweet spot with almost 80% probability of profit. This could be a very interesting trade. And again, if you don't have calls, if you don't have a call spread, you can do a trade on the other side as well, a naked call or a call credit spread. But I think trading on gold is always a good opportunity, especially when volatility is this high, because gold's not going anywhere. Gold's, the price of gold is not going to shoot to the moon unless something very weird happens. Even if it does, we can manage it. And it's not going to go to zero. So I always like to take trade on gold when the opportunity comes. And in this case, I always like to check GDX and GDXJ. But the volatility on those are not so high. GDX here, 36 IV rank, not so good. And GDXJ is not even here. Sometimes NUGT is good too, but it's not here this time. So GLD it is. I think it's a good place to consider trading, selling some theta, making some money on a good underlying.